Okay, we have a lot to cover this week. A lot of interesting points to talk about. Um, have a look at our rates here, capital market rates, and look at this bottom line. All of the red numbers down here, they're all negative. This is year to date. So the market, if we look at the 10-year, for example, the market has already cut interest rates by 39 basis points. Same with the 30-year. The market's already cut interest rates by 36 basis points. On the 7-year, it's cut interest rates by 41 basis points. So the market's already cutting interest rates. This is precisely what the Fed doesn't want. The Fed already warned the market about this. And even in the minutes, the Fed said, we are concerned that the market might mistakenly think that we're doing something else. And that would be a mistake. And I think they use the words concerning. Well, this is not going to sit well with the FOMC. The FOMC wants to continue to raise rates to a higher level, and the market is already cutting rates. Look at the 1 month, up 46, the 2 month, this is the beginning of the year, up 18, and the 3 month up 25. Nothing week over week, but look at that again, another 26 basis points on the 1 month. Sitting at 4.58 is above the target range of 4.25 to 4.5 and well above the effective federal funds rate of 4.33%. And when we get to the DXY, we'll look at what happened in Japan on Friday. Thursday and Friday were significant, although it didn't get a lot of attention. It is important, and it could be a big issue next week. And I think that what we're seeing here is the beginning of the unwinding of a carry trade. And perhaps there was money sitting in the short end of the curve that has to find its way back to Japan right now. And we'll see if that's going to be a big issue. But the big issue I see right here is in the capital markets. The market is already cutting interest rates. Ahead of what the Fed wants, the market's already cutting interest rates. You're 17 days away from the next FOMC meeting, so there is going to be a quiet period before that. So if there's going to be Fed speak, they got to get it out of the way in the next little while. Look at what's going on next week. 8 separate speakers, but some of them are speaking twice, right? Tuesday you have 1. Monday the markets are closed. Tuesday you have 1, followed by 4 on Wednesday, 3 on Thursday, and 2 more on Friday. They have to be concerned about the market front-running the Fed in terms of cutting interest rates, because basically a 10-year down at 3.49, 39 basis points lower than where it ended the year, is a rate cut. So anything that's pegged to a 10-year treasury just got a 40 basis point rate cut. If we look at our slopes, the 2 to 10, 73 basis point inversion, that's 193 days now that it's been inverted. The anticipation is it's probably going to be inverted until a recession, that the long end of the curve is not going to increase with rates high unless inflation starts to run away again. It's hard to imagine inflation running away upwards again with a Fed that's going to keep rates at these levels. So it's probably going to stay inverted until the 2-year drops. The 3 month to the 10-year, negative 118 basis points. This is 81 days now. And remember, it is depth times duration. The deeper you go and the longer you stay that way, the longer you've changed behaviors of market participants, consumers, and business investment. And that collectively begins to weigh on future growth. At some point, there can be no future growth if there's no current period investment. Effective federal funds rate 4.33%. Reverse repo down another 28 billion. Still elevated over the 2 trillion mark. That is being paid 4.3%. This is now less than the 30-day T-bill rate. So we might see this start to, rather than take 4.3%, if you can move it into 1 month at 4.58%, because this over here is important to pay attention to this little thing that I put in over here with just a snippet of volatility. The top line here is the 2-year. The 2-year volatility, 151.42 down to 137.73. and the 30-year from 135.94 down to 123.40. So volatility is dropping, and with volatility dropping, your duration risk drops as well, because rates or yields becoming less volatile allows you to take on more duration risk. So if you got to park money overnight, you don't want any duration risk in it whatsoever. Well, that with volatility dropping, it makes the 1 month a little bit more attractive. So at the margin, it's drawing money into the 1 month, but yet the 1 month is increasing. So there must be more selling going on in the 1 month than there is buying. And we'll try to tie that to the actions of the Bank of Japan last week. FOMC, it is pretty much, a done deal for the market here. 93.7%, up from 75.7%. Only 6.3% on 50 basis points because, nothing is for certain, right? Down from 24.3%. If we look at June 14th, because on a worst case scenario, the Fed would raise 3 more times, which means no raise in June. Where would the terminal rate be? It spans 475 to 575, and all of the probabilities have shifted towards the lower end of the upper range. 5.75, 0.4 to 0.3, that's saying that there's really nothing there. 9% down to 6.2 at 5.5, almost 38 down to 36. 45 up to 48. So the weights have dropped from 5.25 up towards the 5 and increased at the 4.75 and the 5, implying that there probably are only 2 rate increases left. But that doesn't matter. Again, capital markets here are already cutting interest rates ahead of the Fed. Fed balance sheet down 1.2 billion. That was all T-bills, sitting at 7.997 trillion versus 7.999 trillion, 1.2. I mean, that's a rounding error. It's not even worth paying attention to. But T-bills ran off. It's just the time of the month. There are certain dates of the month where they mature. And during this past week, nothing matured. Real yields have dropped again from the 5 to the 10. Still inverted, but only by 9 basis points. Last week was 17 basis points. And break-even rates have all dropped again, except on the 5-year. But they're such small moves, I'm not going to read too much into that. If we look at the federal funds futures, last week, May, June, July, it was sitting at right around 95055, an implied rate of 4.945. Down a little bit. We're 4.905 to 4.92 across these 3 months. Going from 995.055 to from 4.945 down to about 4.92. Not much, but it is there. This is interesting here, and I just can't in my head get the logic for this at all. December is at 95.44, pretty much the same thing as last week. It was 95.43, implying a rate of 4.56. So that this is pricing in, 2 rate hikes, and then we're going to be sideways for a while. And then by the end of the year, you have 2 rate cuts. If you were on the call for JP Morgan's earnings, they are forecasting pretty much the same thing. 2 rate cuts in the second half of 2023. So they see 2 rate hikes in the first half and 2 cuts in the second half. They did say that they were just following the forward curve, but I don't know, I didn't hear any pushback against the forward curve, but they were following that. So they were just basically following what's going on here. If we look at the forward 1-year rate, 1 year, the 1 year, 1 year forward, this is hard to say, 1 year, 1 year forward minus the current 1 year, it's negative 94 basis points, implying that in 1 year, the 1 year rate will be 94 basis points lower, most likely reflecting some of the rate cuts that are happening, at least 2 rate cuts that are happening in the latter part of this year, and it looks like 2 more rate cuts over the next 2 to 3 more rate cuts over the next year. I can't see how that is reasonable. And when we get to later on, I'm going to talk about a soft landing, and we don't know if we're going to have a soft landing or not. But what we can do to determine whether we'll have a soft landing is we can ask the question, is a soft landing possible? And I'm going to show you that under the current conditions that we have, a soft landing is simply not possible. So if that's not possible, you can't have 2 rate cuts. I don't see that you're going to get 2 rate cuts. You're either going to get no rate cuts, or you're going to get 200 to 300 basis points of rate cuts. Because if you have a soft landing, there is no way you can cut rates, and we'll see why you can't cut rates. You'll get none, or you'll have a recession. The economy will turn down very quickly, and you'll get massive rate cuts at the front end. But to get 50, that's just not a possibility in any scenario that I can come up with. So I think this is completely wrong to be pricing in 2 rate cuts by the end of the year. It'll either be no rate cuts or a whole bunch of rate cuts, but it won't be something reasonable like, well, I think we can go 50. That's not going to happen. TLT had a good week, up 1.45% week over week. S&P was up 2.8% though, but still TLT did okay. It gave way at the end of the day, but it was heading up towards 108 and gave way by the end of the day on Friday. Implied volatility sucks now. 13-week implied volatility, the implied volatility percentile, third percentile, 97% of all the observations in the last 13 weeks were above this. So it's heading right down. 26 weeks at 19%, 52 week at 28%. Last week you had 45, 37, and 41. 41 down to 3. Volatility just came right out of this. So selling 1 month puts on this doesn't have a lot of premium. The premium has just disappeared. So I had, it went up. I have calls. My calls went up in value. I've already worked off some of the price of the calls. I'm not money neutral yet. But I have a whole year to get money neutral. I don't have to get it done by the end of February. I got a whole year to get money neutral. So I have no position changes on this one. I am on hold right now. If it continues to go up and up and up, the way I would get money neutral is I would go above my strike prices, maybe to 120, 125 on TLT for the same month, January 2024, and sell upside calls. So that if there was a pullback, since I sold those upside calls, I'd make my money there. I'd just sell the upside calls, even though implied volatility is dropping. You gotta work that money off somehow, right? May as well get it somewhere. So the upside call is probably what I would do. I would only sell puts at this point if we had another rise in rates and bond prices dropping. If TLT got back down to, again, the 102 range, the 101, 102 range, there is where I would start to think about selling puts again, but not until the implied volatility increases. Okay, OAS, look at that. All of them down week over week, and this is as of Thursday, by the way, not Friday. We don't have Friday. Friday was a big enough drop in yields that we would have seen even more contraction in spreads on Friday, but we won't get that till next week. Look at that. Double B, negative 15.7% contraction in yields, 46 basis points, down to 2.47. Triple B, 1.64. Triple B is the lower part of investment grade. Double B is the upper part of high yield. And high yield is really showing that there's no fear here. 7.94 is the yield on high yield as a category overall. The OAS 4.29. It is difficult to imagine an endogenously led recession without stress in the credit market. Endogenous meaning that it happens through its own weight, that the economy goes into a recession through variables that are endogenous to the economy, such as consumer spending, business investment, that sort of thing. It's hard to imagine an endogenously led recession without stress in the credit market. If you get stress in the credit market, it's very easy to imagine because credit dries up. Well, you got to roll over that debt. If you can't roll over that debt, you got to get that money from somewhere, or you got to default. And if defaults start to increase along those lines, then more credit dries up. Lines of credit get canceled. If they're not committed lines of credit, they just get canceled. And then it becomes very difficult to meet your debt obligations. And then companies have to start worrying about cash preservation. Well, there goes staff. Very quickly, there goes staff. So credit is a big problem when there's stress. However, it's hard to imagine an endogenously led recession without the credit markets. And the credit markets are just not coming along for the ride. They are perfectly happy where they are. Moving over to the mortgage market. Again, the Fed can't like what's going on over here. 6.33 on the 30-year week over week change, negative 15. But this is as of Thursday. To get Friday, if we go to Mortgage News Daily, they have 6.09 as of the 13th, heading down towards a 5 handle. The 10-year U.S. Treasury 30-year fixed rate mortgage as of the 12th had contracted 3 basis points. That's the spread between the 10-year and the 30-year. If we account for Friday's move in the 10-year Treasury and the mortgage rates, that spread has contracted 33 basis points week over week. 33 mortgage applications for the week ending, this is the week ending last week, up 1.2%, refis up 5.08%. And as the 30-year mortgage rate drops, you'll see more and more refis. Purchase basically flat. MBS ETF, MBB, year to date is up 3.08%. If we look at the mortgage REITs agency, up 9.18% year to date. That's just January 3rd to today. Or is it January 2nd? First trading day of the year was January 3rd because the first was a Sunday. Yeah, January 3rd. Annaly up 7.69% year to date. The difference between the mortgage-backed security ETF and a mortgage REIT is leverage. Is the difference of leverage. What do we got this week in the housing market? Wednesday, 10 a.m., National Association of Home Builders Housing Market Index. The expectation is 31. It's a diffusion index. Anything under 50 is contraction. It was 31 last time. The expectation is for 31 again. In other words, no further contraction, but no growth at all. Thursday, 8:30, building permits. Previously were down. This is for the month of December that we'll be getting this data. November was down 10.69%. Housing starts we get for December. November was down 0.5%. And Friday at 10, existing home sales, again for December. November was negative 7.7%. So all of these negative numbers. Mortgage apps for the last couple of weeks have been, mostly positive. And the mortgage rate has been coming down. And if we take Friday's print from Mortgage News Daily, because they observe actual rates being posted, whereas Freddie uses a survey to get their rates. 6.09, it is highly likely, unless you get major Fed pushback against the market cutting interest rates on the long end of the curve, unless you get major pushback from the Fed on the market front-running the Fed, it is highly likely you might see a 5 handle on the 30-year mortgage before the end of this month. Okay, let's turn our attention to the jobs market, and we're going to revisit some of the data in the jobs report from last week. This is initial claims for the week ending January 7th. We got, these are 1 week behind when they're reported. They're reported for the week before. So for the first week of January, 205,000. So if initial claims stay in around the 205, 215, 225 range, you're going to, in February, you're going to have a positive jobs print again. You need to see this number for initial claims increase above 275 to 300,000 just to get no jobs. Once you start seeing 325, 350, 375, you're going to have job losses. Continuing claims went from almost 1.7 down to 1.634, dropped by 63,000. So that the insured unemployment rate is now 1.1. It was 1.2. So let's look at some of these numbers here. I have temporary help services. I have average weekly hours. We've seen that. And we're going to look at overtime hours. A pattern that we typically see to determine, because we're fairly confident we're in a slowdown. Some economists think we're already in a contraction, that the numbers are showing we are in contraction. Some say, no, we're not in contraction. We had entered contraction a while ago, and we're coming out of contraction. That will end soon. But I sort of think that, we've seen the slowdown, and what's next? A soft landing means slowdown to future growth. A hard landing would mean slowdown into contraction. And if we do go into contraction, the consensus is, it's going to be a mild recession anyways. But a mild recession is not a soft landing. It's a recession. So for slowdown to contraction, there are some regularities that we would see in the jobs market. Temp staff and overtime hours are cut first, and then hours are scaled back. So let's have a look at temp help services. This is October, November, December, and this is December of last year, was positive. October, a drop of 22,000. November, another drop of 30,000. December, another drop of 35,000. That's temp staff being cut. Let's look at overtime hours. And again, this is December. This is total. This is for manufacturing here. This is total for everything here. 3.2. And this is October, November, December, 3.2 to 3.1 down to 2.9. For durable goods, 3.3 to 3.2 to 3.1, and non-durable 3 to 2.9 to 2.7. So we see temp staff being cut. We see overtime hours being cut. And we also see average weekly hours, 34.5, 34.4, 34.3. Last December was 34.8. So when you look at the average work week, it has shortened. Temp staff is being thrown out, and the amount of overtime hours available are dropping. Once we get to this point, we're still printing positive job numbers, so we're not done yet. This usually happens first. If it continues on, you start to get job losses. It'll be in the part-time category first. Well, we didn't see that for December. We saw that 100% of all the jobs were in the part-time category. All those job gains came from the full-time equivalents of part-time jobs. Well, that's not healthy for an economy. That signals that there's an extremely tight labor market, and you probably can't afford the full-timers. So you say, well, why take a full-time person on when we can use 2 part-timers? We don't have to give any of them benefits. We can pay them less per hour. They don't qualify for any of the other services that we offer employees. We can schedule them in such a way that we never have to pay them paid holidays. So Monday is Martin Luther King Day in the U.S., which is a paid holiday if you're a full-time employee. But if you're part-time, you're not getting any of it. They're cheaper to get, which is why we saw a smaller increase in average hourly earnings. The big thing to watch is the ECI. This is the Employment Cost Index. And we get this for the fourth quarter of 2022. We're going to get January 31st. That's going to be a big number to watch because the Fed is the very next day. So they're going to have this information. And it comes out, the Fed meeting starts on January 31st, and then they make the public announcement on February 1st. So this comes out at 8:30. They're going to have this before they start. That is the measure of wage inflation. Because it takes a job, a specific job, and it doesn't consider an individual. It doesn't say, well, how did you fill that job? It doesn't do that. It takes a job, and then it looks at that same job in the next period and say, what is that same job now paying, whether somebody's in it or not? So it looks at the change in what it costs to fill that job, regardless of the person you hire. What does the job pay, whether you can fill it or not? And that's the measure of wage inflation. Also interesting, we get union membership for 2022. This comes out annually. This is on January 19th. In 2021, union membership in the U.S. shrank by 241,000 to 14 million. And it has been on a decline since the early 80s. So we've heard a lot about, this administration being pro-union and union-friendly. Well, we get union membership for 2022. There was a full year. We heard a lot about unions, different companies, employees voting for unions. Let's see what happened on net to union membership. We'll get that on the 19th. We're at 14 million. 2021 saw a decrease of 241. Let's see what's going on. Any increase, because in this report, in the union membership report, it does contrast average hourly earnings for union members versus non-union. And it shows that non-union employees tend to make 83 cents on the dollar versus unionized employees. So if union membership increased, that is not friendly for wage inflation. That is actually negative for wage inflation because union membership does push up wages. Okay, before we head on to the next screen, let's look at table B9. This is from the jobs report. Indexes of average weekly hours and payrolls for production and non-supervisory employees. Let's have a look at index of aggregate weekly hours. Let's just look at total private percent change from November to December. Notice that it is negative. We saw average weekly hours decrease, so it is negative. Index of aggregate weekly payrolls, 0. Because you did have an increase in average hourly earnings offset by a decrease in the work week. So combining the two leads to 0 growth month over month. That's important for the screen that we're going to get to. Okay, here we're going to look at the personal saving rate and gross private saving. And it should have an S because there's a difference between saving and savings. Savings is a total stock of everything you have. Saving is an activity. You're doing something, you're saving. And it's measured as a percentage of disposable personal income, DPI, and it clocked in a nice low number of 2.4% over here. Well below roughly, the 6 to 7 to 8% that you had post-Great Recession. You have a savings rate now of 2.4%. So I did some calculations here. I calculated the average debt per worker, non-housing. It is $30,066. I didn't do per capita, I did per worker because workers have cash flow. I know that non-workers have cash flow as well. There's unemployment. There are all sorts of entitlement payments that go to those who don't have a job or that are unemployed. But the population also includes 6-month-old babies. Do we expect them to have any kind of cash flow? Not really. Now the population also includes retirees that are living off of their savings at this point in time, but still I made the decision to say, well, let's look at it as average debt per worker, $30,066. Interest rates are up on a floating rate credit by about 500 basis points. On some of it, it's up significantly more, especially credit cards is up by more than 500 basis points. But I just said, let's assume that the average of all debt, this 30,000, this non-housing debt, is up by about 500 basis points. So per month, that's an extra $125 in debt servicing costs. So if the average worker has $30,066 in debt, given the increase in interest rates over the last year, that means they're now facing an extra $125 a month in debt service. Then I said, well, okay, let's calculate the average disposable income per worker. And this includes, all the raises that happened over the last year. What is, as of the end of the year, what's the average disposable income per worker? $7,580 monthly. In other words, this 125 represents about 1.65% of your disposable income. The saving rate is down to 2.4%. If you add the two together, you get a little over 4%. April of 2022 was sitting at 3.6%. So the drop from 3.6 to 2.4 is coming from increased debt service. So you have a lower savings rate because of increased debt service. So consumers seem to be sacrificing their savings to continue their level of consumption as opposed to pulling back on consumption and maintaining a savings rate. We can see that if they were maintaining a savings rate, it would be somewhere, well, take this off, somewhere around 4%. And 4%, this is the 5% line over here. You can see 4% is historically very, very low. Look at what happened here before this last recession is you had a saving rate that was well below 5%, and you're starting to see that over here. And this was a period of time where the Fed was raising rates as well. They got it to 5.25%, and it was at that level, I think, for a good 8 months, 9 months before the crash in the market actually happened, before the Lehman moment actually happened. So it can, on its own, this low saving rate lead to an issue later on when it is forced that way through a higher debt service cost. This is the stock of savings. You could see that this is the pandemic over here. So you have to sort of take that out. It's come down. So if we go, if we say, well, you had a savings rate here that looked to be about 7.5% over that decade. So it should have increased the stock of savings by that rate, accounting, of course, for any market volatility, because savings just don't sit in the bank account. They typically go into mutual funds, which go into equity, so that the stock of savings is subject to some level of volatility. That's why you have, it's never just a straight line. It always has some volatility. And if you overlay the stock market on this, the stock market would probably have that kind of volatility. We can extrapolate that out to see where it should have continued on, and we see that we are below that number now. So on a trend basis, the stock of savings is below the trend growth rate that it should be at, and this could be a signal that consumers are dipping into their savings to make ends meet. Consumer credit change for November was released on January 9th. Up 7.1% on a seasonally seasonally adjusted annualized rate. Revolving credit, the most expensive, is up 16.9%. Non-revolving up 3.9%, and this could be auto loans. They're non-revolving. Revolving is typically your credit card debt, up 17%. For the month of November. We've already seen retail sales for November. We got that report in December, and there was nothing good about the retail sales report. There was just nothing good about it, and we're going to get retail sales again this coming week. Household debt and credit for Q4 of 2022, we're not going to see till February 16th. This is quarterly. We're not going to see that till February 16th, but from the last report, household debt hit a total of 16.51 trillion. That's up 2.36 trillion higher than pre-pandemic, than 2019. So in just a short period of time, we added 2.36 trillion to total debt outstanding. Mortgages and HELOCs, home equity lines of credit, this is all real estate backed, make up about $12 billion. To put this into a little bit of context, if we look at owners' equity in real estate, it is 29 trillion 550 billion against 12 trillion in mortgage. This is the widest margin ever between equity versus debt. So if you add the two together, the 12 and the 29, you get about 41.5 trillion in total real estate value. You got about 12 trillion in debt, so that's close to about a 30% debt equity ratio. About 40% of homes are fully owned. So if you back out the 40% of homes that are fully owned, for the remaining homes, you got about a 50% debt equity ratio in those homes. So there's a lot of cushion to the downside. So I don't know that you're going to see any kind of significant housing crisis. The last home price index we saw had an annualized rate of 4%, so that from the peak to where we are now, nationally, home prices have given way 4%. 4%, and you still have a significant amount of equity sitting in homes right now. Credit card loans sitting at a total of $1 trillion. That's up 15% year over year. And I think that's the largest increase in like 20 years in credit card debt. Auto loans, 1.5 trillion. Student loans, roughly about 1.6 trillion for debt. I point this out because this is important. Is the debt service cost, if rates are going to stay elevated for this whole year, like the Fed says, we're raising rates to 5% and we're going to leave it there for an extended period of time, then this debt servicing is not going away, especially on this kind of debt, on revolving debt. So the credit cards, the auto loans, that needs to be serviced, is pushing up against 1.5% to 2% of your disposable personal income above what it would have been had rates not gone up. So you have to come up with more of that, and it seems to be coming out of the saving rate, which is affecting, and maybe even the stock of savings. And the last time rates were high, where the savings rate dipped, it did precede a recession. So just to finish up on that last screen before I get to this one, there was a point that I had wanted to make that I didn't make in time. On the conference calls for the banks, especially on the JP Morgan call, and you're going to see it on the Goldman Sachs call, most definitely you're going to see it on that call, is the experience with credit cards. And delinquencies are increasing. Delinquency is you're late. So it's the entrance into delinquency that's tracked, and the write-offs that are tracked. And they are increasing, but on JP Morgan's call, they stress that it's really just returning to historical levels, because it was really low for a period of time. And it was low for a period of time. I think it was their charge-off was like as low as 1.47. And for 2019, it was around 3.1%. They're forecasting 2023 to be around 2.6%. So even though 2022 saw 1.5%, 2023 will be 2.6%. They were quick to point out that, hang on a second, 2019 was 3.1%. So even at 2.6, it's going to be below historical average levels. Yes, elevated significantly year over year, but below average levels. Well, that has to be expected when debt servicing costs end up being 1.5% to 2% of your disposable personal income. And if you're living paycheck to paycheck and you have no savings, no stock of savings, then yeah, something has to give. Let's look at some more things related to capital markets. We'll look at debt, and this last one down here is equity. The first one is U.S. corporate bond issuance. Look at December. December basically disappeared. The total outstanding of U.S. corporate bonds is $10.1 trillion. Issuance in 2022 was $1.35 trillion, which is down 31% year over year. November, investment grade, $103.8 billion. In December, dropped to $6.6 billion. High yield was 10.4 in November, dropped to 2.2 in December. And convertibles, 1.9, dropped to 0.6. This is less than 10 billion, from 103 billion down to 10 billion. This is corporate issuance in December. But with the market cutting interest rates on capital market bonds, and with the OAS contracting, I have seen numbers for January to date. I think there was $5 billion in high yield issuance already to date, and that investment grade is on track to be somewhere around $95 billion this month. So, when you have credit expanding like that, that again is not really what the Fed wants to see. MBS issuance, well, that's no surprise, right? Straight down in line with the mortgage market. Issuance was $2.145 trillion, down 53% year over year. Total outstanding $12.2 trillion. If we look at November versus December, in commercial mortgage-backed securities, none were issued in December. Residential mortgage-backed, this is non-agency, none were issued. Collateralized mortgage obligations, agency collateralized mortgage obligations, 12.813 versus 11.3 the month before, and agency MBS about 88 billion versus 92.6 billion the month before. Well, I don't think that that's much of a shock there. In short-term debt markets, looking at commercial paper outstanding, there's really no stress going on there. Here is October, November, December, and this is non-financial, October, November, December. Same here, October, November, December. I don't really see anything in there that I would say, well, this appears to be a problem. If credit markets tighten because of counterparty risk, in other words, that there's too much perceived credit risk in lending money, you're going to see it in this market very quickly, that you would see this start to drop because it's much more high frequency, because it's commercial paper. So it has terms that are less than 1 year. I think less than 270 days. It's short-term paper. Equity issuance, 99.4 billion, which is down 77.2%. This is we're looking at December here. IPOs. Sorry, this is not for this. This is for the entire year. Sorry, this is for the entire year of 2022. 99.4 billion was issued, down 77.2%. IPOs, 8.5 billion in IPOs, down 94.4%. The IPO market is basically gone, and market cap of the S&P 500 stood at 4.1 trillion. And this is month over month. This is November, December. IPOs 0.2 to 0.1. Secondary offerings 9.5 down to 6.4. Preferred stock 9.7 down to 6.4. So these two, the corporate bond issuance and the equity capital formation, are important. If we look at a company's CapEx, this is their capital expenditure for the course of the year. It's a combination of what's called maintenance CapEx. In other words, it's the amount of CapEx you have to make in your business just to keep your business going, because machinery wears out. So you do have to replace tractors, you do have to replace trucks, you do have to replace different pieces of equipment in your shop. And then there is growth CapEx, which is investment into new productive assets. Usually when rates increase, growth CapEx drops. But you have to keep maintenance CapEx going. And most companies target a specific debt equity ratio because they target a particular cost of capital. And if you're targeting a cost of capital, there is a proportion of debt and a proportion of equity that you use, that when you have your plans for your CapEx, let's say it's $2 billion and you're targeting a 50% debt, 50% equity, or a debt equity ratio of 1, that means you're going to have to raise $1 billion in debt and use $1 billion in equity. And equity can come from your retained earnings, can come from just the cash that you have on your balance sheet. That is considered equity. And there is a cost to using that. It is not free, because you have to think of what the alternative is, and you have to do better than the alternative. And the alternative is to give it back to shareholders. Well, if you give it back to shareholders and you actually needed it, then you would have to issue equity. Well, that's why there is a cost to using cash, because it is equivalent to issuing equity, but not issuing equity, because you're not really buying back shares and then issuing equity. You're just using your cash, which is in itself the buyback and the reissuance, right? So there is a cost to it. Well, the higher the cost of debt, the higher the cost of equity, because debt has a prior claim on assets than equity does. So we can get some idea of the amount of business investment, that is going in to CapEx through watching the amount of issuance going on. So when you see issuance dropping on both sides, where's investment going? You can get equity and debt issuance to zero if no company has any CapEx. If every company out there says, well, we're not going to invest anything into CapEx, That means that we know we don't need any incremental debt and we don't need any incremental equity. We're good. When you have something that looks like this, and look at these numbers, negative 77%, and negative 31% year over year, that is a hit right to investment, and investment is future growth. So you have to say, okay, well, if we are going to get growth in the future, we haven't invested in that growth yet. All right, for the next two screens, let's run through a thought experiment about the possibility of a slowdown. Nobody really knows what's going to happen. But what we can do is say, okay, well, let's assume this particular scenario does happen and let's play it out. Let's see what happens if it does happen. Because right now the capital markets are already cutting interest rates. The equity market is already willing to accept a higher multiple of earnings week over week. That market goes up, means that investors are willing to pay more for earnings. So you have, a higher multiple on the market and rate cuts going on in capital markets. The markets are already saying it's a soft landing and we're going to move on to growth. If you weren't going to move on to growth, you would not be willing to pay a higher multiple of earnings, right? And lower rates are supportive of growth. So let's go ahead and do a soft landing, which is slowdown to growth. Well, you've got a tight labor market as it is. Where are you going to get the employees from? Growth requires employment. Unless you plan to get all of that growth through efficiency gains, through productivity, you're going to have to hire people. Where are you going to get them from? We're going to be right back to stealing employees from other companies, and the way to do that is to offer them higher wages, right? You're going to get wage inflation. You still have a quits rate that is over 4 million. We get that from the JOLTS report. You may not believe the job openings, but the quits rate is fairly objective. For example, here in Canada, if we have an employee and an employee quits, we have to fill out a record of employment, an ROE, and we have to submit it online because we have an employment tax account. And we have to let the government know how many employees we have at any given time. And when they leave, we have to submit an ROE, because if they show up to get unemployment, well, then they need some record of their employment to determine if they have enough hours to qualify. So you can count. And when we do submit the ROE, there's a number of reasons we have to give, layoff, termination, termination with cause, quit, all of that. So you can actually check the box quit. If you do quit your job, you don't qualify for unemployment. Only if you get fired or if you lose your job based on a decision made by the company. So we have to file that record of employment. Well, you can count those. So you can look at the quits rate and you can say that's most likely an objective number. So we can just use logic and say, would over 4 million people be quitting their job every month if there weren't job openings? Probably not. So the job openings of over 10 million is consistent with a quits rate over 4 million. It's also consistent with an unemployment rate at 3.5%, and it's also consistent with a level of wage inflation that is higher than what the Fed is comfortable with. So we don't have to be exact. Is it 10.5? Is it 9.8? Is it 10.3? Maybe some jobs are posted 3 or 4 times. It's double counting. Maybe they're not real jobs. It wouldn't matter. We can arrive at the conclusion that it is consistent with all of the other data. So I'm not going to quibble over the actual number. It is consistent. We have a tight labor market. If you try to get growth in a tight labor market with 10 million job openings already, you're going to push that to 12 million and 13 million job openings because growth requires employment. You're going to push wages back up, and you're going to have one of two outcomes. Companies are either going to have to say, well, we're not going to raise our prices, we'll just eat it. We'll be the hero here and we'll have margin compression, or prices are going to have to go up. More than likely, prices will go up. So there's your goods inflation, there's your services inflation, there's your wage inflation. Rates are going up for longer. If you do get a soft landing to growth, inflation is coming back because the labor market is simply just too tight. There is no slack in the labor market. You will hit that inflation wall right away. That's higher rates for longer are not supportive of growth. So I can't see how you can get growth with a tight labor market with this type of response, which is negative for growth. So you could end up with just, well, a slowdown. A soft landing could be, well, you just land and you don't get up. You just have persistently low growth. So think about somebody on the top, on the roof of a house, and they're jumping off the roof of the house. They can land on the concrete driveway, which is called a hard landing, and they'll hurt themselves and break things. Or you could put an air mattress down, a big, huge air mattress. They could jump off the house, land on the air mattress, bounce off the air mattress into the ground. There is your growth. They elevate back up. Or the third option is they jump off the roof, they land on the air mattress, and poof, they just stay there. They don't even get up. They're not hurt. They just don't get up, and there you go. Well, that is persistently low growth, where you simply just come down and then you just go flat for a long period of time. Well, if you have persistently low growth, it'll probably keep wage inflation in check. And with low growth, it's hard to keep pushing prices up, so you might have prices in check. This is negative for EPS, and it's also negative for the multiple. You usually would pay a higher multiple when you have a forecast of higher growth. If you have a forecast of, real GDP growing at 0.3, 0.5, 0.7, sub 1% real GDP growth, you're not about to start saying, well, let's pay 18 times for that. No, let's pay 19 times for that. No, let's pay 20 times for that. You're not going to do that. The multiple wouldn't be justified. So you'd probably have about a 4%. I just took a number that's benign. Let's go down 4% on EPS. I don't know that you get a lot of pushback there in a low growth environment. But the multiple, we're at 17.5 now because we're expecting a move to higher growth. If you have persistently low growth, probably 16 at the higher end, about 3,500 on the S&P 500. Let's go to recession, and let's just see what happens there. That's slowdown to contraction. And based on the jobs report that we saw, the trend in overtime hours, the trend in temporary services, this is consistent of a market that is going into contraction. In a recession, the labor market will loosen. Inflation will drop, demand and prices drop, but you're going to also have an earnings recession. EPS, you can expect to drop 10 to 20% in a recession. However, it does allow the Fed to cut to support growth, and sooner if credit markets falter. So typically the market turns up before EPS bottoms out. So your multiple will start turning up before your EPS bottoms out. So the low part of the multiple, I'll say, might trade down to 14, but you'd have a higher earnings. So 14 times 220 would be 3080. By the time EPS bottoms out, the multiple, the market already anticipates that it's going to bottom out. The multiple would be higher. Let's go to 18, but the EPS bottoms out at 200, you're 3,600. So you're around 3,100 to 3,600 in a recession. A low growth environment, you're around 3,500. A slowdown to growth with a tight labor market simply cannot happen. It simply cannot happen. So you're either going to have persistently low growth, which means a lower multiple and probably lower EPS, or you're going to have a recession. But one thing that I can say quite clearly here is no cuts unless unemployment increases. So the idea that we're going to get 50 basis points of cuts this year is simply not going to happen. Either you're going to get no cuts this year because unemployment is not going to move, or unemployment is going to rise significantly, the economy is going to hurt, you might get some credit market issues, and you're going to get way more than 50 basis points of cuts. But it's nowhere in between. It's a quantum difference. Either you're going to get nothing or you're going to get a whole bunch of something, but there is no continuum here. There are two states. So no cuts unless unemployment increases or credit markets falter. A slowdown to growth in a tight labor market is simply not possible. Okay, let's explore this low growth environment a little bit more, and we'll draw out an equilibrium in this state, and then we'll see if we can move to an equilibrium from this state to a high growth state and what it would do. But we have to change our notion of equilibrium. Most textbooks, well, all textbooks, draw out supply and demand curves, and the intersection is an equilibrium point, and then they'll shift one of the curves, which is usually incorrect. But, you know, they're doing it just to make a point that if you shift one of the curves, you will end up with a different equilibrium point that has different prices and different outputs. Or they might say, well, now we're out of equilibrium, we got to get back to equilibrium, which is really not a very helpful concept at all. You cannot add something to an economy and have the economy move to a new equilibrium and then remove that very same thing and expect that the economy will just go back to the way it was before you added that thing. It doesn't work that way. So you can't say, well, we're in this state, let's add something, we'll get to this state, let's subtract it, and we'll just go back to this state. It doesn't work that way. If you add something and move to a new state and then you subtract it, you'll move to different states. There's nothing saying you'll move back to the original state that you were in. You'll just go in some other direction because the economy adapts to this point, and this is where they are right now. That if you simply removed what you put in, it's not just a linear effect. So we have to think about equilibrium in a different way, and in thinking that way, we cannot just shift a curve, we must shift and twist curves at the same time. In other words, the slope of the curve becomes extremely, extremely important when we're looking at equilibrium points in complex adaptive systems. So let's be clear, an equilibrium here is not a mean reverting level or state. In a complex adaptive system, like any economy is, it is a state in which there are no runaway positive or negative feedback loops. So let's draw out our current equilibrium point in a low growth environment. So in a low growth environment, we're going to take the job market we have. Here's our supply of labor, L. We know we have a tight job market, we have a constrained participation rate, and we have low population growth. These are facts. These we know. You can have a low participation rate, but if you have a high population growth and the participation rate is, let's say, 62%, it's 62% of a growing population, you'll have a growing labor force. But when you combine a low participation rate with low population growth, where are the workers going to come from? We know that the generation that is retiring, 10,000 retirees a day, is larger than the generation coming in. So the size of the labor force is under a secular shrinking pressure, probably till 2020, unless immigration really, really increases. Well, do you see that happening in the US? Do you see that happening? I don't. So I think that we can say that this is the state of the world right now. Well, in this state of the world, you're going to have very low price elasticity, which means you're going to have a very steep supply curve. Let's assume that you had a market where the labor force cannot grow. Let's say that you have a participation rate of 62% and you have 0% population growth. And that participation rate is not going higher or lower, you would have a vertical supply curve, which means if demand shifted upwards and upwards and upwards, all you would be doing is raising prices and holding quantity fixed because you have a constrained labor market. So we have to draw the supply curve to reflect the labor market conditions that we have right now, and it is very steep and upward sloping. The demand curve will be downward sloping. It has higher price elasticity than supply, but it is steeper than it would be because, well, if you need employees, you need employees. You can change the mix of employees you have, but if you've got to get 10 boxes out the door and you need 5 employees to get 10 boxes out the door, if you only have 4 employees, you can only get 8 boxes out the door. You are limited in your revenues and your growth by the amount of employees that you have, so you can then decide, well, let's just pay somebody more to get the 5th one in because at least we can get those boxes out the door. Without them, we can't, and we can always just raise our prices, right? But corporations, like I say, they can shop around. They can change the mix of their employees. They can say, well, rather than hire 10 full-time employees, why not hire 20 part-time employees? We can pay them less, and we do see this going on. So they do have some more flexibility. So they're not as price inelastic as supply is. They have a higher price elasticity than supply, but still a quite steep curve. And this is our low growth environment. And if we stayed in a low growth environment, companies would say, well, if I expect low growth, I don't need as many employees. Maybe I don't need all of these job openings. And if the job openings start to drop, people will start to say, well, I'm less willing to quit my job because the job openings are disappearing. Wage pressure would start to decrease as vacancies start to decrease. And that would take time to play out. You'd have to stay in a low growth environment for an extended period of time. And if you do stay in that environment, interest rates will go to 5%. And they'll stay at 5% until that problem is solved. You're not going to get rate cuts with a tight job market. Let's just take the condition we're in right now. And again, just make the point that it's difficult. At this point, it's going to be difficult to go to a high growth environment. But let's just move to a high growth environment. So this is low growth. This is the price in a low growth environment. This is the level of employment in a low growth environment. Let's move to a high growth environment. And in a high growth environment, we're going to need more labor. So the supply curve is what the supply curve is. And if we're going to a high growth environment, demand, corporations are going to have to become less price sensitive, which means that their curve is going to tend to steepen a bit more. So let's steepen their curve and let's shift them outwards, and they would end up over here. Well, look what happens. You have your price that goes here, but look what happens to employment. Barely moves. That you're just not going to get the increases in employment, and to get increases in employment would require significant wage inflation. Well, if that starts happening, wage inflation finds its way into prices. It finds its way into goods prices, and it finds its way into services, unless companies are willing to sacrifice their margins. If they're willing to sacrifice their margins, earnings expectations are too high, which means equity prices are too high. If they're not willing to sacrifice their margins, that means inflation is not over, interest rates are too low, they got to go higher. That's the discount rate for all earnings, meaning equity prices are too high. So I don't think that we can go to an environment where you have high growth, simply because the labor market just won't allow it to happen. And if you do try to get there, inflation is right back all over again. Well, how can we fix this particular problem? This is the way out, is that you do get this kind of thing going on for a while, where you do have a low growth environment for a period of time, and wage pressure is abating and vacancies start dropping, so you have the quits rate that starts dropping. Well, what are you going to get to the, let me erase that. Here's what's going to happen to the supply curve, is it will rotate along its equilibrium point most likely. It'll stay in that position, but it'll start to do this. It'll start to become less steep, which means that if you do get an increase in demand at this point, notice what you get here. You don't need as big an increase in wages to get a significantly higher increase in employment. So what needs to be done is you have to move the economy into a point where the supply curve starts to flatten. It's far too steep right now because the job market is too tight. The only way to do that is to introduce slack into the labor market. There is no slack. There is no slack into the labor market. You have to get slack into the labor market. Now, as you're flattening out the supply curve, the demand curve will do the same thing as well, because companies will say, wait a minute now, there is slack in the labor market. We really can be a little bit more price sensitive. We don't just have to pay up for them. So what is going to happen is the demand curve will start to oscillate around that equilibrium point as well, and you'll get something like this. So that if you do get a shift in demand, this is a shift in demand outwards, there you go, you have a much more balanced market at that point. The flatter those curves are, the better it is able to handle fluctuations in employment without any of these runaway feedback loops, When you have a very steep curve, and I'll back all that stuff out, when you have a very steep curve and you have an increase in demand, you end up with significant increases in price for almost no increase in employment. Well, then that causes goods prices and services prices to increase, which is inflation, which is met by higher rates. That's that cycle that starts again until it breaks the economy and brings it back to an equilibrium where you don't have those kind of feedback loops. So right now, the idea of going to a high growth environment from a slowdown simply can't happen with the job market where it is. So I think, a fairly uncontroversial conclusion here, and one that I think that is very tradable. You cannot have a soft landing with a tight labor market, period. So there is only one thing to look at right now, which is the labor market. And unless you introduce slack into the labor market, you cannot have a soft landing. But the record is very clear. Whenever unemployment rises by at least 1%, it has always led to a recession. So if you introduce slack into the labor market, you can create the conditions for higher growth by removing wage inflation, but you're only going to bump up against those limitations at some point unless you actually fix the underlying problem, which is you have a labor market that is not growing at the same speed that you're going to need for an economy to grow. So I think this whole idea of soft landing, where we come down and then off we go, this touch and go, is just not reasonable. You're either going to get one of these for an extended period of time or one of these. That's it. But the up is gone. You can have persistent low growth equilibriums or a recession. And the recession, I think, is the only pathway to higher growth at this point. You have to flatten this supply curve and you have to flatten that demand curve. You have to make them far more price sensitive. And the only way to make them far more price sensitive is to introduce slack into the labor market where an employee says, I'm not going to hold out for a 5% wage increase. I need a job, and I can see a whole bunch of people need jobs and there aren't that many openings. I'll take a 3%. And companies can say, why are we offering 10% to lure employees over here? There's a whole bunch of employees. We only have to lure to pay them 3%. You need to make them far more price sensitive, which means you got to flatten those curves. Okay, big story on the VIX, 52-week low. It is sitting at 18.35. Last week was 21.11, a drop of 2.76, a 52-week low. You have to go back to January, I think it's 11th of 2022 to get a VIX that is below 18, that is lower than 18.35. So we're at a 52-week low, and we've broken down below the upward trend that has been in place since before 2022. If we look at the futures curve from January all the way to July, look at the drop in all of these. All of them are dropping. Look at SPX, the implied volatility percentile, 0%, 0%, 2% in the last 52 weeks. That means in the last 13 weeks, every observation of implied volatility has been higher. In the last 26 weeks, 100% of the implied volatility observations have been higher, 98% over the last 52 weeks. The implied volatility on SPX, the last observation at the close was 15.9. Historical volatility, 17.6. IV is lower than historical volatility. IV is forward-looking. Historical volatility is backwards-looking. So the anticipation is that historical volatility is going to drop. The 20-day straddle pays 3.3% versus if you look at Occidental Petroleum, the 20-day straddle pays 7%. There's just no money in the premiums. If you're going to use it as an income generator, it's extremely low and extremely dangerous because I believe it is underpricing risk at 18.35. But that's a big move on the VIX in 1 week, hitting a 52-week low. If you wanted to buy puts on the SPY, They are cheap at this point in time. The other big move this week was the DXY. Look at that drop right at the very end over here now at 102.2. The CAD sitting at 13369, $1 gets 133.69 Canadian. The peso with an 18 handle. I said this about a month ago that I do expect to see an 18 handle on the peso, and it's doing fantastic. This down here is the Mexican stock market. This is the 5-year chart for it. Here it is right here. Look at that. This is the beginning of the year, and there's the end of the year. It was barely down last year. It's up, and it doesn't have much to go to hit an all-time high. If we look at EWW, which is a US dollar Mexican ETF, it holds Mexican equities. It's at a 52-week high. Implied volatility of 20.5%. The 20-day short straddle is running around 3%, so there's not a lot of money in the options here, but it's at a 52-week high. 2022, this EWW had a total return of 1.12%, so while the SPY was down 18%, EWW actually had a positive year, 1.12. Its dividend yield sitting around 3.2%. It is at a 52-week high. This doesn't give you any peso exposure. It is a US dollar ETF. So you have the benefit of the Mexican market rising while the peso is getting stronger at the same time, showing up in the total return here, so that you don't have to hedge out. You can get exposure to it right away. Printing an 18 handle. I don't know if it has the ability to return to a more longer term level of 13 to 14, but let's find out. The yen is the big story, 127.86, and it's continuing on. On Friday, the 0.5 level on the 10-year, remember they moved it from 0.25 to 0.5, got breached. Hit a high of 5.45 on Friday, closed Friday at 5.05. Above the 0.5 target. The bond market is now openly fighting the Bank of Japan in the belief that they're going to have to abandon yield curve control because they've blinked. They've shown, the bond market believes they've shown weakness, and they're going to keep pushing on it. So this is going to be an issue. On Friday, they bought 5 trillion yen worth of JGBs right across the curve from the 1 to the 25, 5 trillion, which is about 39 billion US on Friday. The day before, they had to buy 4.6 trillion yen on Thursday to protect the 0.5. Even with the 5 trillion yen on Friday, it still broke the 0.5. So that's I think a big part of what's going on with the dollar here. The big drop in the dollar, I think, is yen driven. And it's going to unwind the carry trade, because as the yen gets stronger, since you borrowed in yen, which was a low yielding currency, since you borrowed in yen, probably at the shorter end of the curve, if you've borrowed in yen and the yen is strengthening, that's going to destroy any return you get. So you got to repatriate that money back to Japan very quickly. You got to pay off that debt. Well, look at what is going on with the 1-month treasury in the US for a period of time. If you're borrowing yen at a 1-month rate and investing in the US, the front end of the US curve at a 1-month rate, that is a nice carry that you're getting. Well, if you've got to sell those T-bills to repatriate money, you got to sell the T-bill, which means the yield would rise, the US dollar would drop because you got to sell US dollars, and the yen would increase because you got to buy yen. Well, that is all consistent. You have the yields on T-bills increasing. You have the US dollar decreasing and the yen increasing. If you describe the steps in a carry trade unwind, that's exactly what you would expect the footprints to look like. And there was a lot of work done on Thursday and Friday, almost 10 trillion yen. So you're looking at $75-80 billion equivalent in US dollars. That is the pace of runoff per month on the Fed balance sheet, and Japan pushed that into their balance sheet in just 2 days. Next week is going to be critical to watch this. This could be an issue. This could really drive the US dollar down, which means the Canadian is going to increase, the peso is going to increase, the yen is going to increase. In fact, I'm thinking that if the yen shows any weakness early in the week, I think I'm going to go long the yen. I'm going to take a long yen position and see what happens, because I don't think the market is just going to say, you know what, let's stop messing with these guys. Let's just stop messing with them. I don't think that's going to happen. I think this is, the sharks are circling and they're seeing this, and I think the sharks are coming in. The BOJ can do some shock and awe to hurt them and push them back, but you know, I don't know that they would do that. Perhaps they'd be willing to abandon yield curve control, but not abandon monetary policy. In other words, keep their policy rate where it is, manage the short end of the curve, and say, fine, you want the high end of the curve, the longer end, the capital market rates to go up, go ahead. Because their last inflation read was 4%. And the market is saying, you know, with inflation at 4% and the 10-year at 0.5, come on, man, come on, something has to give. And if you're going to keep rates low at the long end, this is going to continue to go up. You have to have a bear steepener in this curve. We're just going to make it so. We're just going to keep selling these bonds because it's eventually going to have to go up. And if there's this massive selling in the 10-year, somebody's either got to buy it or they got to let it go. And if they do let it go, you're going to have a major unwind of that carry trade, a major unwind which could cause some problems. The beneficiary of the dropping dollar, gold up another 2.6% over 5 days. Copper, though, killing it, up another 7.41% over 5 days. Now, that doesn't mean copper will continue to outperform gold. Gold is probably the best pure play on the dollar, that if you expect a significantly weaker dollar, gold is where you want to be. Copper is tied up with industrial production. So there's a lot of optimism tied up with copper as well, that if you expect market optimism to continue and a US dollar, copper gets a double benefit from that. But if optimism disappears, a stronger US dollar may not help copper, that the pessimism in global growth would drive copper prices down, just not as fast as they would normally go. So there you are on how to position on what's going on. But I think the big story next week is this guy right here. If we look at the performance, this is, I think, a 1 month performance for the yen, the Canadian dollar, and the peso. The Canadian dollar is up about 1.6 against the US, the peso 5.5%, but the yen over 7%, up over 7%. That's something, especially for the yen, right? But the Bank of Japan right now is on a cusp. If they abandon yield curve control, I think you got to go long the yen. I think you probably got to go long gold, probably short the dollar, long every other currency except the U.S. I think that's the way that you would play it. I don't know what it would do for capital market yields in the U.S. And I don't know the effect that it would have on equity markets. I can't play it that far to see what effect it would have. It starts to get cloudy and ambiguous once you start to get to those. Okay, SPY. Let's see where we are here. The forward 4-quarter EPS is down to 227.67 from 228.38. SPX closed at 39.9909, just below that 4,000 number. That's a 17.56 times earnings. And this week there are 26 companies reporting earnings. It is a short week. Monday's closed. I think 20 of those 26, 20, 21, 22, something like that, are all financials. So the financials continue with Goldman Sachs coming out of the gate on Tuesday morning. And its credit card division, that's what everyone's looking at, is expected to show significant loss. I think they pre-announced $3 billion on that one. SPY closed at 398.50, 200-day moving average 397.28, so it's above the 200, it's above the 50. 50 is still below the 200, so the downward trend is still in place from technically speaking. 18 times is 408.48. So the only upside resistance you'd get to is on a fundamental level at 408.88, and you have right around that level, you have your previous peak. So we had the trouble over here before, right? And it got to the 407 to 410 congestion area, and it just couldn't break that and pull back. You have a reverse head and shoulders appearing to form here. It is a higher low on this side, but you did have this going on here. Like if you didn't know what was going on at this point in time, let's say this part of the chart didn't exist, and on this day you'd look at it saying, well, we had a low, we had a higher low, we're going up. You would have said, well, we had a higher low here, and that didn't work out. That was the heavy September sell-off. This was your October lows, and maybe we've made a lower low, but it could be another one of these things before we head back down again. Implied volatility percentile all dropped 6%. On the 13-week was 16. Even the 52 down to 15 was 25, so they all dropped significantly. The 20-day short straddle is paying 3.3%. It just isn't that exciting. This green line here, this shaded green line moving upwards here, means I am long the underlying shares of SPY. I've been long since low 380s, 383. We're sitting at 398, so I'm up about $15 per share. But I am short the June ES contract, which is a E-mini, which is comparable to being short 500 shares. So I mean, I am long and I am short. I'm long shares and short the futures. But in being short the futures, I do have positive carry. So there was when I did take the short based on where the index was, there was I think 32 or 3,300 of positive carry that I would have already had. So any loss I suffer will be $3,300 less than if I had just simply shorted the SPY. I'm going to continue to hold that short position. I'm net long overall because I do have home builders, I do have mining exposure, I do have mortgage REITs, and I have a bunch of REITs as well. Although I have started offloading some apartment REITs that have rebounded and that I'm in the money on. I've not completely gotten out, but I've paired my position, and I've also reopened short calls on IYR at $90. I've sold some calls, some February calls at $90 on IYR. IYR is a REIT ETF because the underlying REITs that I have, some of them don't have any options at all. So as a portfolio, I have to find something rather than try to sell calls on every one. Some of them have illiquid options, some have no options. It's easier just to move to an index. And REITs have had a wickedly strong start to the year. I don't know if you've been watching any REIT performance, but my God, they've had a beautiful start to the year. I think one of the best performing sectors out there overall. But I don't know that you have a lot more upside to the apartment REITs. When I say a lot of upside, is there another 10 or 15% I can squeeze out of it this year? I don't know. If you look at Zillow's rent tracker, it is showing that rents are rolling over, that the growth from month to month is now negative. So if that's the case, then apartment REITs have had a good run, and I think apartment REITs will be a good investment to be in, but I think they'll be more of a neutral investment, not a growth investment. So I have started paring down my positions. Again, not that aggressively, but at the margin, I am taking maybe 5-10% off of each apartment REIT position and selling calls on IYR as a family altogether, because I do think that if you do have a soft landing with an attempt for growth, inflation's coming right back, rates are going higher, higher rates are negative for cash flows for REITs. If you have a soft landing with just a low growth environment for a period of time, it's going to be some time before rates come down. Higher rates are a negative for REITs. And if you do go into a recession is just negative for everything overall. So I don't know that there's a lot of upside left to the REIT trade, so I am willing to sell there. As far as SPY, there's not a lot of excitement in the options at this point in time, and I am more likely to say, well, let's just hold on this for now. Let's move from the level of the market down to the level of the positions, and let's see what we can get done on certain positions. I don't know that I need to use the SPY as a hedge against anything when it just doesn't have that much excitement in it anymore. I should say something about the auto companies. Tesla cut prices again in the US. That solidifies the end of those margins. So last January, it had peak margins, I think, of 30 point margins. Those are in its past. I had done a video earlier in the year stating so much that given the nature of competition in this industry, it is only a matter of time before those margins disappear. So all car companies took a hit last week. Most of the legacy automakers have been around long enough to know that nobody wins in a price war. Coke and Pepsi understand that too. That's why they don't get into price wars anymore, because they both lose. They both understand that. Same with the airline companies. The major airline companies know that nobody wins in a price war. Tesla hasn't been around long enough to know that. So they're beginning, is it the beginning of a price war? Will the other companies follow suit knowing that nobody wins in a price war? However, from a game theoretic perspective, if somebody does lower their price and you don't, you risk losing customers. So even though it is a suboptimal decision to enter into a price war, it is even more suboptimal not to enter the price war once it has been declared. Now, I think that the auto companies, because they have legacy and they can still generate huge cash flow on legacy because it requires little investment at this point. I had made this point before that they are more willing, or could be more willing, to survive an extended price war on EV because they do have legacy, whereas Tesla has no legacy to fall back on. Which means if there is a price war coming to the EV market, the biggest loser will be Tesla because 100% of its revenue is EV generated. It has nothing to fall back on. And that creates a big problem, because if you have a price war on EV and the prices of EVs drop, demand will increase, and battery material components are already at elevated prices. You will just push those even higher. So if your input costs end up getting pushed even higher, but your prices are going down because of the war, that is a no-win situation for anybody in that industry. No producer, no investor at all. It may be a win for the consumer who gets an electric vehicle cheaper if electric vehicles end up being the technology of the future and not just some transition thing that we're going through now and realizing that in 15 years, it's this technology that's the winner. Maybe hydrogen is the big winner in 15 years. Who knows? I mean, you really don't know, right? But as far as my Tesla position on that one, because I do have options and I am trying to get the cost. If Tesla's dropping, I am going to roll my options and hopefully get Tesla for free. If it goes up, well, then I make money. Week over week, I've not had to change any of my positions. So if you have the applied series, I've been updating you on my strategy of how I'm rolling the options. There is no change week over week, but my opinion on the auto companies has changed. I'm less willing to use Ford and GM as as an income factory at this point. I think the miners and energy companies are going to be a lot more interesting in 2023 to play for that, because they do have significantly higher yields. When I say yields, I mean if you look at the 20-day short straddle as a percentage of its price, it's significantly higher. Implied volatility, on GM really dropped last week as well, which makes the premiums that less attractive. I want companies that can trade within a range, that are fundamentally low priced so that there's not a lot of downside, that have good premium in the options, because you can do so well in just playing the options on either side of that thing. And I got squeezed out of SPY. Now I'm getting squeezed out of GM. So, the hunt continues. Let's have a look at who's reporting earnings this week. We'll look at the economic calendar, and that's a wrap. Okay, let's go through this. This is for January 13th. A few things I think are interesting in here. 2022 Q4 earnings expect to be negative 2.2. If you take out energy sector, negative 6.6. And the market in the last 2 weeks has shown itself willing to pay a higher and higher multiple for those shrinking earnings. Let's keep going here. This is interesting. There have been 57 negative EPS pronouncements issued by S&P corporations compared to 35 positive. So the NP ratio 1.6 for the S&P 500. Earnings just keep coming down, and this is the week over week that we saw already. Let's go to some of the tables here. This is Q4. Let's keep going here. Q4. There we are. Q1 2023 earnings growth rate. This is a forecast for the earnings growth rate. 0.5%, 23 Q1 over 22 Q1. 0.5% earnings growth. And like I said, the market just shows itself willing to pay a higher multiple for what is basically flat growth. Look at all the negative signs that you get in there. And if you exclude energy, look at energy's 23.2. If you exclude energy, it gets even worse. If the energy sector is excluded, the growth rate declines to negative 1.4%. I don't know why we would be pushing up towards from 17.5 towards an 18 multiple given this forecast for Q1. This is revenue growth rates. This is Q4. We don't want that. This is revenue growth for Q1. Here it is right here, 2.5% revenue growth. Inflation over 2023 is going to be higher than 2.5. So revenue growth of 2.5 means real revenue growth is negative, which means Q has to drop. If P is going to increase by more than 2.5%, which is the price level, and revenues are only going to increase 2.5, Q must drop because revenue is price times quantity, right? So the real amount of goods delivered by the S&P 500 must be dropping. If we come down here, there's the 227.67 for the forward 4 quarters. Let's see who's reporting this week. Monday, nobody. Tuesday morning, there's Goldman Sachs. Estimate 548 a year ago, 1081. There's going to be $3 to $4 billion hit from their consumer segment. Morgan Stanley, Citizens Financial, Signature Bank, and then you got an airline in there. That's no wonder there. 210 versus negative 160. Airlines have been on fire. Going into Wednesday, JB Hunt. So we have a transportation company. Prologis, this is warehouses, distribution centers, logistics centers, things like that. PNC Financial, Charles Schwab's, Kinder Morgan, Discover Financial Services. Look at this, pretty much all financials. Fastenal is a supplier, an industrial supplier. Comerica, Fifth Third, KeyCorp, M&T Bank, Northern Trust, P&G. That'll be interesting. 159 versus 166. What will be interesting with P&G is not so much just the performance of it. It's a defensive stock. They usually tend to hold up fairly well. That doesn't mean that they always beat the market or always do well. They just hold up better. Their fundamentals hold up a lot better. But if they have any discussion about the mix, the consumer mix, is the consumer trading down to lower priced products or to a lower named brand within their lineup? That will be interesting to see. Truist Financial, Netflix, 44 versus 133. The estimate of 44. Netflix always has these big moves on earnings. Let's see what happens there. SVB Financial Group, and then on Friday, State Street, Huntington Regions, and then you have an oil services company in there, Schlumberger. So it's still very much financials driven next week. I think Tuesday morning's the big one. Goldman Sachs, Morgan Stanley, Procter & Gamble will be interesting. If you're into oil services, of course, you have Schlumberger here, and then Netflix, because it's such a recognized brand. You tune in for that, and they do have volatility. So that's the earnings calendar for this week. We don't really get into the big numbers till next week, and for the next 2 weeks, it's like 170, 180 companies for the next 2 weeks. It's nothing but earnings for the next 2 weeks, and then you have the Fed meeting. Okay, 3 countries on here: Japan, Canada, and US, and we'll just pay attention to the big risk events. Tuesday morning for Canada, CPI, if it follows suit with the US and gives way such that we think that monetary policy in Canada will be more dovish, it will weaken the Canadian. Combine that with a weakening US, I really don't know what the result would be, which one would overpower which. Let's keep going here. Tuesday night, if we are going to play the yen, we have to be aware that Bank of Japan rate decision. This is just a rate decision. I don't know if we can expect any kind of comment on yield curve control at all, but just be aware that that's happening Tuesday night. Once we get into Wednesday, we switch over to the US for risk here. We have PPI at 8:30 and retail sales for the month of December. Expectation negative 0.8. We saw in December, the November retail sales really weren't that great. We'll see what happens for December. Continuing on, I think the next risk event here, building permits. I don't know that we have the housing market already clearly in recession. I don't know that that's really going to change much here. Let's keep going. Japan, 6:30 on Thursday evening. There is inflation rate. If we don't get anything much out of the Bank of Japan on yield curve control, which I don't think we will, depending on how the fight goes between the BOJ and the bond market all week, if inflation comes in hotter than expected, I think they're going to lose that fight at the 10-year. And they may decide just to abandon that altogether, which could be a big, huge event. So I think between Tuesday's Bank of Japan's rate decision and Thursday evening at 8:30, if you're in the yen at all, you've got 2 big risk events to worry about. And that will, there's a lot of Fed speak going on, a lot of other reports, but those are the big risk events. 1 for Canada, which is CPI, 2 for the US, PPI and retail sales, and 2 for Japan. You have the BOJ decision on Tuesday night, and you have inflation on Thursday night.